to reduce their taxes. They grow, their businesses grow, economy in their business.
I am a client of GOCPA.
They've grown, we've grown.
Weren't paying much interest. One of our clients sells their company.
I've recommended dozens of people to them.
Our goal is to use advanced tax planning to reduce taxes, optimize tax savings, and reinvest them into the future so you can get ahead in your wealth. You can really put away $25,000 into a Roth IRA account this year. Well, the answer is possibly. So let's talk about post-year-end tax planning and early 2023 tax planning that everyone can likely do. So today we're going to talk about the Backdoor Roth IRA, right? The term gets thrown around a lot, but let's talk about what it really means. So the first thing to realize is everybody can really contribute to an IRA, whether or not you're at income limits or not. The income limits relate to the deductibility of the contribution. So currently, $109,000 modified adjusted gross income, married, half of that single, is your deductibility limit. So when you're over those limits, that doesn't mean you can't contribute. It just means the deduction is limited. So why would we want to do a traditional IRA if we can't deduct it? We probably don't, right? So what we're going to do is the Backdoor Roth IRA method. First thing to check is, did you make an IRA contribution tax year 2022? If you have not, you may be able to double up on this strategy this year. So here are the steps we're going to follow to do this. Number one, we're going to open up, if we don't already have one, an IRA account, and we're going to make what's called a non-deductible contribution. So when you go and make this contribution, you want to mark it as non-deductible, which is very, very important here with your custodian. So a Fidelity, a Schwab, someone like that, non-deductible. If you're doing a post-year-end contribution for 2022, which you can do up until April 15th, 2023, is going to be $6,000 for you and $6,000 for your spouse if you're married. So non-deductible, $6,000, that's $12,000. You can also at the same time do your 2023 contribution, which is $6,500 for you and your spouse, right? So you have $12,000 for 2022 and $13,000 for 2023. Now, why would you want to do your 2023 contribution early? Well, we'll talk about that in a second, but it's really the power of compounding. So the money goes into the account, non-deductible. You wait a day or two and you have to open up a second Roth IRA account. You then do what's called a Roth conversion and a rollover into the Roth account. This is a 100% tax-free move because you didn't deduct the incoming contribution, right? So on your tax return, that contribution will not be deducted. It's a very important distinction there. It's a non-deductible contribution, then you convert it to Roth. So if you did this now, you can still go back for 2022 if you haven't captured it yet, and then do 23 at the same time. Why would we want to do that? Well, if you do the 2023 early in January versus December, you're talking about $900 to $1,000 in earnings based on typical inflation, typical growth rates, right? If you do this every year at the beginning of the year versus the end of the year, that's going to be substantial savings, substantial growth. Now, what we always tell people is, why not do this strategy and start early, right? Because a Roth's a great bucket, and a direct contribution to a Roth is limited based on income. So a lot of people cannot make direct Roth contributions, and they think they're out of luck. But everybody can do this. Non-deductible contribution into the IRA account, convert it to Roth IRA account, and then you have tax-free growth forever. So if you just contributed $6,500 in 2023 and did that for the next 20 years, that's all you do, right? $6,500 non-deductible, convert to Roth. 65, convert to Roth, right? What would happen? Well, in 20 years, you'd have about $245,000 in a 100% tax-free bucket on about $130,000 of contributions. So not bad, right? Everyone can do that. So contribute, convert, watch it grow, tax-free. One of our favorite strategies, but we like to do it at the beginning of the year versus wait till the end of the year. If you missed out on 22, it's not too late. Go back and do your 22 contribution, and while you're doing it, throw in your money for 2023 to get that extra earnings and see that grow tax-free into the future. With that, if you have any questions, please reach out to us on the Roth IRA strategy or any other retirement planning strategies you may have.